Hello and welcome. Over here. So in this video we'll be looking at technical analysis and its relevance in forex trading. So let's get started. Now, technical analysis is a study of price action through the analysis of price charts of different financial instruments in order to forecast future price action as well as future trends. Now obviously this is a tool which is relevant to the trader because it's the tool that enables you to make a determination of the direction in which the prices are most likely to move, because that's the way in which then you are likely to be profitable when you are trading. Now there are three basic premises which form the foundations of technical analysis. Firstly, that price action discounts for everything, prices move in trends, and history repeats itself. So if you look at this formation, you'll notice that foreign exchange rates are impacted by many different factors in the economy. So economic growth, interest rates, balance of payments in terms of imports and exports, capital flows in and out of the country to basically the local stock market, politics, monetary policies by central banks, bond yields, all would affect foreign exchange rates in one way or the other. So if you had to study each of these factors in order to decide whether the currency exchange rate would move up or down, it would be not only time consuming but extremely difficult to do. So if you analyze forex market by examining these factors would be known as fundamental analysis. Now, according to technical analysis, these factors are already included in the price action of the currency exchange rate, and so it allows you to save time by only analyzing the price instead of digging deep into the economic factors that are affecting the price action. So the first premise of technical analysis that says price action discounts for everything is really powerful, because then it tells you that you don't have to go and look for the economic factors in order to be able to be a forex trader. You only really need to look at the price chart and analyze the price chart, and it will reveal to you in what direction it is moving and able to make profits. The second premise is that prices move in trends. Now, if you look at a price chart of any forex pair or stock or commodity or index, you will find that the price is not going to move in straight lines up or down or flat. It will actually move in trends. So the market will either be moving in a trend which is moving in that direction, which is up, and it's called a bull market, or it will be moving in a ranging market, which is really a price that is moving sideways. There's not much change in the price, or the price will be moving down, and that's called a bear market, when prices are changing dramatically in the downward direction. This is an example of crude oil. If we track it from 1990 to 2012, you'll notice that between around 1990 to around 2000, the price of oil was basically flat, so it was ranging, and then from around 2000 to around 2008 it started trending up. From 2008 to around 2010 it started trending downwards, and it started trending up again towards 2012 from 2010. This is an example of a trend for gold. You will see that from 1990 to around, say, 2004, the price of gold was basically flat, and after 2004 up until 2012, the prices have been going up quite a bit. In fact, it went up as far as 2000 or 1900 in 2011, but it since started trending a little bit down again. So if you have a tool of analyzing the prices, then you would have made a determination that the prices were going to be moving up back in 2004, and perhaps you could have bought gold at that time and then made your profit as the gold prices moved up. This is an example of prices moving in trends in the forex market. This is a graph of the euro versus the United States dollar from its inception back in 1999. You see that as it was brought into the market, it started trending down against the US dollar, but when it came to around 2002, it started trending up. It trended down at around 2005, and from around 2006 it started trending up again, then it trended downwards, then up, and so on and so forth. So you can see that these are the beginnings of the analysis, because if you have a way, for example, of determining that the euro USD is going to be moving up at that point, then you could have bought euros and sold them once the price had changed up for a profit. Now, when we say that history repeats itself, we are basically saying that price charts tend to get arranged in certain patterns that lead to the same outcome every time they appear. These patterns in the price charts reflect human psychology in the market, because it is people who are trading, and they behave in the same way since technical analysis came to use from 100 years ago. Humans tend to behave in the same way under similar circumstances, and this has a tendency to repeat itself when it gets reflected in price. So if you as a trader are aware of these patterns and their implications in the market, it can directly lead to profitability in the market. The concept of history repeating itself is not a new concept. It's even used in normal markets. For example, in the clothing shop, they do understand that human behavior tends to repeat itself, and so every time there's a sale, people tend to flock into the shop and it increases sales, and so shops keep basically introducing sale from time to time, because they know very well that it's going to have a very same effect on a wider range of their customers. Now, when we say that technical analysis involves looking for patterns and analyzing those patterns in order to enable you to make a profit, this is more or less what we mean. This is the first of those patterns that we're going to look at. The pattern you're looking at in front of you now is a pattern of an uptrend. So you can see that's the y-axis, which represents price, and that's the x-axis, which represents time. So as time, of course, goes by, so the price is increasing, and so it's an uptrend. But you will notice that this trend is moving in a very specific pattern. It's being supported by the diagonal line, which is moving up from left to right, and every time the prices pull back towards the trend line, they are being supported and then moving back up, then they pull back down, then they move up. So in an uptrend in a financial market, basically by definition, an uptrend is a series of prices that are making higher highs and higher lows, and those lows are supported by a trend line which is going in an upward direction. So you can see from this pattern that as a strategy for a foreign currency trader, you could basically draw in these lines in a price chart on MetaTrader, and you could wait for a price pullback towards your trend line. And if you notice that prices are failing to break through that trend line, then you could buy that currency pair and make a profit as it moves up. So that could be one strategy that could be used. This particular pattern is an example of a downtrend, similar to an uptrend, but in this case, that's the y-axis and that's the x-axis. So you can see that as time goes by, so prices are going down, but they're going down in a very specific pattern as well. The price is being resisted in this case instead of being supported. So every time the price goes up, it's being resisted by the trend line. So as a strategy, you could, for instance, sell one currency while buying another over there, so that you could make a profit as prices go down. So of course, it would be important for you to be able to recognize this pattern on MetaTrader in order to take advantage of it. Because if you try and, for example, sell over there, then the market can move against you. But if you know and understand that the market moves according to these specific patterns, then all you'd have to do is draw your patterns in, wait for a pullback towards your trend line, and then you sell if you notice that the market is failing to break through it. Because if it fails to go up, well, then there's only one direction to go, and that is down. This is another pattern that appears quite frequently in the markets. Not only is it an uptrend, but you notice that when prices move in the upward direction, and at the bottom it is supported by a trend line, but on top it is being resisted by a line which is parallel to the line at the bottom. And basically these two lines form a channel, And the trading strategy in this particular case, when prices form themselves into a channel, would be to sell when prices get up to the resistance line at the top, and buy when prices get at the bottom, which is the supportive line. And you could do this until prices break out of this channel, in which case you would look for other patterns to trade. This pattern is an example of a downtrend, but it's not only a downtrend. When prices move down, they are being supported by another trend line which is parallel to the resistive line of this downtrend. So obviously, if you wanted to trade this pattern, you would wait for the prices to pull towards the lower supportive line, and you would buy as long as prices are being rejected by that supportive line. And of course, when they get to the top, you would sell if the resistive line of course forms a barrier that is knocking the prices from moving forward and breaking through it. This pattern is an example of a trend reversal pattern. You'll recognize that that section there is an example of an uptrend. So it's an example of this trend. But over time, if that line which has been forming a supportive area all along gets broken by the price, then you know that it's an indication that the uptrend is changing direction. So to confirm that this direction is being changed, you would wait for prices to pull back towards your barrier line, and if it can't break back above that line, then you would sell and make a profit in a downward direction, having confirmed that the uptrend is now over. This is also an example of a trend reversal pattern, but it's a reversal pattern of a previous downtrend. You see that the prices were moving down, being restricted by the trend line which you would have drawn in as part of your analysis. And when the prices break out of this trend line, it means that there is a possibility of a reversal. In order to confirm this reversal, you would wait for prices to pull back towards your trend line, and then subsequently, if they cannot break downwards in that downward direction, then you know that the only other possibility is for it to move up. You would wait for prices to confirm that they're now moving up, and you would buy and make profits in that direction. This price pattern is called a double bottom. You can see that it's characterized by descending prices which are being resisted by the trend line, but at some point all along they've been forming lower lows. So that low is lower than that one, and that low is lower than that one, and then suddenly the next low is no longer lower than the previous low. So you can see that prices are finding a supportive area over there. So basically this tells you that prices are now trying to reverse direction because they've lost the downward momentum. So you would wait for a break above that upper resistive point, as well as a break above this descending trend line, and once the prices pull back towards that supportive area, then you could buy that currency pair and make profit as it moves up. So this is another one of those trends that tend to repeat themselves in the marketplace. This is an example of a symmetrical triangle pattern. So prices here have been in an uptrend, and then suddenly they form themselves into a consolidation pattern which really forms itself into a triangle. In this case, if you wanted to make a profit from it, you would wait for prices to break out of this pattern, and as soon as it breaks out, it tells you that it's continuing in its upward direction, in which case you could then buy the currency pair and make the profit as the pair moves in an upward direction. In this particular case, very similar to a symmetrical triangle, only the line on top is a horizontal line rather than a diagonal descending line. So the prices have been moving up. They are now locked into this ascending triangle, which is characterized by a flat line on top and an ascending line at the bottom. And as soon as prices break out of this triangle, you could then of course wait for an opportunity to buy, and you could make a profit as prices move in an upward direction. and as soon as, of course, it's moved substantially and you are happy with the profits, then you could close the trade. And this is an example of a descending triangle. In this case, prices have been moving down, and then they lose some momentum in the downward direction, and they consolidate into a triangular pattern. In order to trade this particular pattern, you would wait for prices to break out of this triangle, and as soon as they break out, you will sell the currency pair in that direction and make profits as the price is moving in a downward direction. This particular pattern is known as a head and shoulders pattern. As you can see, prices have been moving in an upward direction, supported by this uptrend, and then suddenly they form a new high, but then pull back, and as they pull back and try and form another high, they fail to form a high which is higher than the previous high, which is represented by C. Points E and A are very similar in height, and point C is higher than both point A and point E. So this basic pattern is known as a head and shoulders, where point C is the head and A and E are the shoulders. In order to trade this is also a major reversal pattern, and it normally indicates the end of the uptrend and the beginning of the downtrend. But in order to execute the trade, you would have to wait for a break of this neckline, which is characterized by points B and point D. So you would literally draw a line at point B and D, and as soon as that line is broken and retested from the bottom to confirm that prices are no longer able to move in an upward direction, then you could sell and make a profit as prices move in a downward direction. This, of course, is also a head and shoulders, but it's an inverse head and shoulders, and it works very similar to this head and shoulders, only it's a reversal of a trend which was previously down, which is now attempting to move up. So in this case, you would wait for a break above the neckline and a retest of that neckline to confirm that prices are indeed unable to descend any further down, and you would buy and move in the upward direction. So those are some of the patterns that we look at when we're doing technical analysis. It's patterns that have been repeating themselves for more than 100 years, and in that 100 years they always have the same implication. So as the technical trader, if you are able to identify them on your price charts, then you are able to take advantage of them in order to make a profit. So in effect, technical analysis is key to the identification of trading opportunities and also making you profitable. And then that brings us to the end of this video. Hope you've enjoyed it. Goodbye.